Financing contingencies. This matters whether it's a tiny deal, under $500,000, under $1 million, or if it's a gigantic deal. If it's $100 million plus, this still applies. And I've got businesses that I've listed in both of those ranges. I've got a $105 million listing right now, and that seller is looking at buyers based on the financing contingencies that they have. And then I've got businesses that are $300,000, $500,000, and that seller is looking at those businesses again right on their financing contingencies. If they need financing, the more financing they need, the less desirable they are as a buyer. A cash buyer, A plus, boom. In order of preference. If they're coming in with a significant amount of cash, more the merrier. That gets attention. And you can really set yourself apart by showing that in some way, shape, or form. The bigger deals, they're public companies. You can see their capitalization in their SEC filings. They show it all. For the private deals, the small ones, kind of depends on your comfort level. You willing to show a personal financial statement? Are you willing to show a brokerage statement? Are you willing, like a screenshot, something? The buyers who do get brokers' attentions, and they sure as heck get the sellers' attentions. Now, as a broker, I don't share that with my sellers, but I vet and vouch for them and say, I've seen their personal financial statement, or I've seen their brokerage statement. They have XYZ liquid. They can do the deal. We don't have to worry about that. That is one huge check that we don't have to deal with. A C buyer is one that needs 30 to 50% of the asking price, or the price that's negotiated, is in financing. So they're either asking for that from the seller, or they're using other financing, bank loans or that sort of stuff. Maybe they're leveraging some of their own assets, but that's kind of a C buyer. It's really not that advantageous for a seller, except that there's usually more buyers that are out there that need more financing. Maybe this is a little controversial, but I think the buyers that need 51% or more is an F buyer. They don't have the capability to run the business, from a liquidity perspective and pay for it right off the bat. They may need an SBA loan. For buyers that can only buy a business using the SBA, you guys are going to be waiting for a while, because not all these businesses qualify for it. And then when you do, that adds time to the deal. And a buyer is going to look, back and forth between offers that they're getting. And even if it's one that is not as much, they have to make a decision. The seller's going to make a decision. Well, I'm getting more cash. The buyer has more cash. They may not get more cash. That is kind of an equalizer with the SBA. The SBA gets a lot of cash into the seller's pocket. There's just so many less of those. I think we probably see 10 deals for every that's non-SBA that we do for every one SBA deal. But offers that require 51% in financing, especially if they're leveraging seller financing in that, is not super attractive for sellers. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller?